Hello again and welcome to another video in financing, investments and capital budgeting sequence. And in this one, I will be talking to you about real options. What are real options? Well, first of all, what is a financial option? It is an option to perform a transaction at some point in the future. A call option is an option to buy a stock, a bond, currency in the future. So, in other words, it's an option to make an investment in the future, an investment in a stock, investment in a bond, or whatever. Real options, we use the same language, except that we apply it for real investment. Let's say that you have an option to invest in a building 3 years from now. So, what we're going to do in this video, we will translate the language of real investment into the language of options. And I will show you how you can use option valuation tool in order to evaluate real investments. Or on the other hand, option to abandon. That can be viewed as a put option. Again, an option to abandon a project and get some salvage value out of it isn't different from an option to sell your stock, bond, currency at some point in the future. So, before we begin, in order to perform valuation using a Black-Scholes formula, something that we will be talking about in class at quite some length, you need 6 parameters. You need 6 variables in order to value your option. First of all, you need the stock price. Again, I'm using stocks, it doesn't have to be. Second, you need your strike price. The price at which you actually perform that transaction, whether it's a buy or a sell transaction. The third one will be time to expiration. So how long do you have this option for? Do you have it just for a couple of days, or maybe do you have it for several years? That, of course, will make a huge difference to the value of your option. Number 4, and that is the key here, is volatility. It is volatility of price of this asset. Okay. Why do options exist? Options exist because at the end of the day, we just don't know what the value of the asset is going to be at some point in the future. If there was no volatility, if the prices were completely certain, options simply would not exist. So the higher the volatility, the more valuable the option is. Think of it this way. I can invest now in a project with a very, very uncertain cash flow. Or I can wait and see how that volatility realizes itself. So higher volatility, the greater is the value of waiting and exercising this option at some point in the future rather than making an investment now. The analogy that I like to use here is this. Let's say that you need to predict who the winner of the English Premier League is. And let's say that they play 38 games. They play 38 games in the English Premier League, as far as I remember. And of course, at the beginning of the championship, at the beginning of the season, I mean, there is a great degree of uncertainty of who's going to win. So let's say that I need to make a bet at the beginning with 38 games to go. That is, of course, an extremely difficult exercise. Let's say that Fan needs to make a prediction with 20 games to go. All right, so that is still a fairly uncertain exercise, but with 20 games to go, he already has 18 games to look back at and sort of say, okay, this team is performing well, your cash flow is less uncertain. And then, who's next here? Varun only needs to make a prediction with 3 games to go. So Barun had an option of waiting 35 games. That option is clearly extremely valuable because then that volatility will realize itself and you will actually see what's what. And then you need to have a risk-free rate. And you need to have a dividend yield. Now, for the purposes of real options, dividend yield is not relevant. So we just assume it's 0. From business finance, here I need to use a little bit of a cheat sheet. You know that you invest in projects with positive NPV, positive net present value, and you do not invest into projects with negative NPV. But I will show you that there is a case where it actually makes sense to invest in a project with a negative NPV. And that is the case when you can have an option to make a follow-up investment. Think about computers. Let's say that you invest in a computer, in development of a computer or a laptop that has a negative NPV. But that gives you an option to develop computer version 2. You cannot go straight to computer version 2. You have to suffer your way through computer 1. So let's say that I'll use a red color here. You have computer 1 that has an NPV of minus $150 million. On the face value of it, yeah, not a good project. But it gives you an option to develop computer 2. Okay. Development of computer 2 will require an investment of $700 million 2 years from now. Expected discounted forecasted cash flow is 500 million. So, on the face value of it, horrible, horrible project. I mean, you really don't want anything to do with that. But volatility of cash flows, standard deviation, is 40%. It's enormous. I have specifically and purposefully chosen an extremely high number for my standard deviation of my cash flows, which shows that essentially this is kind of the average expected cash flow, but things can be extremely bad, things can be extremely good. If things are extremely good, you go ahead with this investment. If things don't pan out, fine, you walk away. You do not make this follow-up investment, and yes, in this case, you actually do make a loss because you ended up investing in computer 1 without that follow-up investment. But today, when you make a decision to invest in computer 1, you do have this option of a follow-up investment. If you don't do this, you cannot do this. And then finally, my discount rate, or my risk-free rate rather. And what value did I choose? 5%. So, my stock price here, my asset price, is 500 million. This is what I'm buying. Let me use a green color. My strike price is how much am I buying it for? 700. My time to expiration is 2 years. My volatility is 40%. My risk-free rate is 5%. And my dividend yield is 0. Okay. And then, I mean, you can use financial calculator, or you can just go on Google and search for online Black-Scholes formula calculator, which will calculate you the value of this call option, and it will be $286,000,000.88. Do you invest in computer one? The answer is yes. Even though it has a negative NPV, it comes with an option that is much more valuable than the initial loss that you suffer. In class, I will talk about abandonment option to either abandon the project immediately or wait and see what happens and abandon it later. This will be in the form of a put option. We will be discussing that in class, and I will see you in my next video. Thank you for listening.